It's now my pleasure to introduce Katja Taipalus from the Bank of Finland, who will be addressing bubbles in asset prices and are they detectable in advance. Katja, welcome.
Okay. First, I want to thank you for the invitation once more. Even though I'm from the central bank, it was a surprise for me that these actually are quite the questions that we deal with the central bank currently are quite close to related to these with the earlier stuff. And I hope that I will try to get you the idea of what we actually are doing with the early warning signals in the banks. This is not only us, but it's more like ECB is doing the similar kind of things and all the other major banks. Okay, here's the introduction. Maybe I will skip this one, but then more about why central banks are actually trying to locate the bubbles. Okay, I guess it's quite clear if we think about what happened in 2008 and even previously. Clearly now we see that there is clear connection with the financial stability of the financial markets, the macro markets, how the real economy develops, and it actually creates strong incentive to try to figure out what is going wrong, possibly wrong in the financial markets. And then the other thing is that when we usually previously had only interest rate policies, monetary policies, nowadays we were granted with a lot of new tools which are called these macroprudential tools. So we are a little bit in the trouble trying to get the idea of systemic risks well in advance to be able to do something with policies. As we all know, policies take time to have an impact to the economy. Usually we think that it's 1.5 years, 2 years before. So when we are talking about these early warning signals, which we are supposed to find, we should find them well in advance to be able to react. Okay. And then, if we talk about the requirements which we think are crucial for an early warning tool and early warning indicators, we see that the indicators should be frequently and easily updatable because we need to follow closely the developments in the economy and in the finance. So we need an updated signal nearly, not daily, maybe monthly. And the messages these indicators and signals give, they should be easy to interpret. The given signals should be reliable. They should not give too many false alarms, and they should not miss the systemic risks. Although I might say that the loss function is probably not symmetric for the central bankers. We need to know false alarms, or we don't see false alarms as equally bad than the missed warnings because we are not focused on simple single indicators. We always look at several different indicators. And when we're talking about bubbles that we are trying to find from different kind of series, we are usually referring to periods which include, of course, extreme speculative price appreciation in housing or in bonds prices or in stocks. And we regard these periods where the prices detached from their fundamental justified levels. Another thing is that we regard them as rational bubbles, meaning that we think that the investors know that the prices are getting detached from their fundamental prices, but the risks are thought to be equalized with the amount of price appreciation, so it's rational to stick in. And in order to have the wide applicability in the indicators, we are looking for indicators which should be found on such features which would appear to be common to all periods, referred as bubbles. And of course, when we are in search for features which would be common for all periods, all markets, all countries, it's very hard to find. Therefore, one thing that we usually look for, or should look for, is of course the behavioral things. But because we are not able to locate them, we are not able to track them, we have to stick to the mechanical side. And if we look at these two periods, these are from different stock markets. This is from Nikkei, from Japan, and this is from Standard & Poor's, from US. But there are quite similarities in this behavior of these two series. There is very strong upheaval and then crash. Even though the periods are quite different. And when we think about the common features, this is actually what we are looking for. And if we think in time series, what kind of behavior reminds this? It's the unit root. And there we have simulated unit root process. So the similarities are quite striking. There we have unit root, and there we have the Standard & Poor's real-time series. There we have the similar kind of behavior. This is explosive series. This is something hard to find. But the similarities of these two series actually give base to the method that we are using. Okay. Therefore, we are looking for the changes in the time series process. And how do we locate these changes? Unit roots have been, or unit root tests have been used a lot, testing the structural breaks in this area. So if we think about these periods, they are actually used in such a way that they test the whole series at once. The problem, of course, with the traditional tests is that they're not able to locate these fractions in the series. So what we try to do is to split the testing so that we are able to evaluate one period at a time. And does it help? It seems to be working just fine. So this is actually the rationale or the theory behind the pricing method. So if we talk about housing prices, testing housing prices, or testing stock markets, this is actually what we are looking for when we are looking for the unit root processes in the stock markets or in the housing markets. Because according to these Campbell and Lowen, McKinley, Campbell and Schiller, Crane, Costas and Zerletis, according to their research, if we find a unit root in the log dividend yields, this is consistent with the rational existence of the rational bubbles in asset prices. And this is actually the theoretical background of what I was actually explaining before. And then about the testing method what we are using. To avoid the problems which the earlier methods have had is to use two kind of modifications. One is to use short samples that roll ahead one period at a time. The thing of this is that we always get an evaluation for each period. So each period we have an evaluation. Are we in bubble? Yes or no? The sample length is restricted to 36, 48, and 60 observations, mainly due to the fact that if we think about how the stock market behaves, the bubbles are usually building up, I might say, in 4 or 5 years. So it's mainly based on the phenomena. Okay. Then the other modification. So even though we are relying on the old tests, Dickey-Fuller and ADF, we are using them in a very inconvenient way, I might say. We are just using the coefficients from the both regressions. So the interpretation, we are always counting out the least square estimate of the AR coefficient, and then in the other one, the ADF coefficient. And the interpretation is that if we have coefficient which is 1 or 0, 1 or above, that is held as a signal of a bubble. Or then, on the other hand, if we have coefficient value which is 0 or above 0, these are actually interpreted as a signal of a unitary presence in the sample, meaning that there is actually a bubble present in the sample and in the series. This seems a very simple method, but when we tested this out with the Monte Carlo simulations, it seemed to work quite okay. I hope I have them, yeah. The core results from the Monte Carlo simulations were that the amount of the false alarms stayed quite low using the modified ADF and the AR. On the other hand, most of the simulated unitary periods, which we simulated in the middle of the series, did signalize out. But of course, when we are talking about single observations, there seemed to be some trouble of getting all the signals correctly. Okay, and then I might go through the real data applications. This is just an outline of those. They were tested with housing prices and stock market prices. There are problems with the housing market data because the rents are too persistent. So when we take the dividend yields from housing markets, we usually get too many signs of bubbles because the rents are too persistent. The signals are compared with the consensus booms and bust periods, and it seems that both of these new indicators are actually able to spot the major booms as well as the busts correctly from the stock market data and also partly from the housing market. And thinking about us in the central banks, it's good that the signals received do come out as year or even 1.5 years prior to the peak. So it leaves a little bit time to react. Okay, then the real data applications. This is maybe not very clear picture because the time frame is quite wide. This is actually the Standard & Poor's 500 index. These blue lines are those periods which in consensus literature or in consensus research are held as bubbles or very strong downward revisions. Then these red ones here are alarms of bubbles. This goes from 1871 until 50, and I would like to show this area a little bit better to you. So this is actually what happened in 1928 and 1929. What we see here is that when we have very highly rising prices, this method gives us an alarm of bubble, meaning that during this period, the prices compared to the dividends actually rose too fast. So it gives a signal of break. This is actually a bubble signal, as we referred. In here, we got another bubble signal. This is negative bubble. And it means that in this period, the prices, according to this method, has gone down too far compared to the dividends. Okay, then the latter period. Once again, this is the index, and here we see the, for example, the technology boom. And what actually the method does give a warning signal before the technology bubble, but here's the problem. I will show you it a little bit more with the more detailed results. And this is basic problem of the whole method. Actually, it can be seen better in here. This is a little bit too small, but what it says is actually, we all know that the technology boom did last until 2001. What this method does, it gives a signal starting already from the 95, 96, 97, 98. But what then happens, there is a strong downward correction which didn't last long, but it was quite strong. And it was caused by the Russian default and the LTCM. And this actually has an impact to the analysis of the series. So whenever there is a strong downward correction, this method thinks that there is a reversal in the trend. So it actually, the bubble signals stop. And it actually gives a bubble signal once more in 2002 and 2003, but these are like negative bubbles. And the problem is with the method that whenever there's a strong revisions downwards, it needs 7 or 8 observations of unit roots in a row when it starts to give the warning signals once more. Okay. And then we're talking about, or probably thinking about where are we now. So this is the SP500 signals until the 15th of September. And when the zero limit here is regarded as the bubble signal, we actually see that we're not in the bubble yet. But when we compare this period to the earlier ones, it's quite obvious that these signals start with a very sharp reversal to the zero limit, and actually we are doing good way up. So we might be getting signals at least soon. Okay. Then if we think about how these methods could be applied to another kind of data, and are they applicable, for example, a wider set of data, it seems that they work quite okay. There's a whole bunch of housing market data following now, but I try to skip some of them. Here is the Spanish situation, and now we have counted out the method that I showed you, and then also the Phillips method, which is quite close to the method that we are actually using. And these are actually the crisis periods marked here. And then when we're looking at, for example, in Spanish case, the property prices to rents, we see that there is a strong upward movements and growth rates. These are actually giving signals during these so-called regime changes. And they seem to work just fine with the periods. The same thing goes with the island. So actually, when we think about the crisis periods isn't here. But what happened before? We know that there is a strong upward growth in the property prices in real estate sector in Ireland, and this actually is well located with those times in early before 2007. Okay, same thing goes with France. These are signals that actually signal for the break in the trend. Same thing here, but then we have some weird warnings here. So what we actually are trying to do, this is, by the way, this is price to rent and this is price to income, so they are a little bit different. So what we are trying to do now is to try to figure out how many warnings should we get in a row to make these signals a little bit more reliable. So whenever we get one or two, I guess that there might be false alarms possibly emerging. This case is for Ireland. Price to income ratios once more. We get warning signals here, and then in 2005, during the very strong upward movement. Same thing for Belgium, and then Finland, for example. We did have banking crisis in the early 1990s, and it was actually, or before it, we did experience an enormous upward growth in the housing and real estate sector prices, and this actually gives warning in a nicely couple of years before. So what it means is that actually in here, in the late 1980s, we should have tried to do some restrictive measures in order to be bringing it a little bit down. And then we could think, because these previous pictures were based on the pricing theory, they were all somehow related to price to rents or price to dividends ratios. But we actually could think that if this method is actually not based on just on the pricing figures, if we could think that this is actually something to do with the process dynamics, and the signals could actually signal the change in the process dynamics. So this is actually what we wanted to try out with these. So here, for example, is the household credit to gross domestic income. This is Spain. So here's the household credit, and here we see that there is clearly a break. And what does the signal say? The signal said there is break in the trend, even though it's small, and here as well. So it clearly seems to function quite nicely with the periods. The problem is that, of course, the periods are quite long, and this red line actually is the household credit to GDE gap. This is what the Basel is actually looking at. So these are actually differences between the long-time trend and the developments currently. And here's another one, household credit to GDP. Once again, this seems to be able to find out the breaks in the structure, in the dynamics, and somehow. And here's the figure for Great Britain. Same thing. And there are a couple of more figures with different house prices to grain. And here's the Finnish case. So it seems to be able to locate, in some sense, these changes in the structures. And I think this case, for example, shows that it's not only the positive ones, it's also the negative ones. So breaks to the both directions. Okay, but then about the conclusions. It seems that these simple time series methods can reasonably well spot the simulated unit roots from the time series and spot the real market bubbles from many different kind of series. But what we still are looking for is to try to figure out what actually are the right levels of giving the signals. And as I mentioned, the methods are sensitive to sudden downward revisions in time series. And of course, there is still a lot of work to be done, as I mentioned, with the critical limits, talking about the early warning signals. But in a sense, it seems to be promising. Okay, that's all. Thanks.
Okay, question for Katja, please. Ole?
Well, if I may, yes. The microphone will take you.
Hi, thank you very much. So, just out of curiosity, you showed a lot of quantities that are a dollar amount divided by a dollar amount divided by a time scale. So time scales. Mm-hmm. So, for instance, you show price to rent.
Yeah.
If the price of a house is $100 and rent is $10 per year, then price divided by rent is 10 years. Is there a reason that why you're interested specifically in time scales? It would seem at least interesting to compare, let's say, rental yield to interest rates. That seems something that determines affordability of these assets.
Yeah,
why are you interested in time scales?
Well, actually, this is just one part of it, because usually we are doing things like taking into account the interest rates and stuff like that, and counting out how the people are able to survive with their interest and housing loans. But this is a little bit different kind of stuff, because when we're talking about early warning indicators, we're usually stuck with the, if we think about what kind of levels might be dangerous in economics, we're usually stuck with the distributions when we try to figure out which would be the right thresholds. And then we always confront the criticism concerning the thresholds. We're also doing that thing with the thresholds, but this is a little bit different, because this is actually based on the time series dynamics, in a sense that we are trying to locate the spot when something changes in the time series dynamics, and when we get the signal from the change, we of course have to look what is behind that. It can be a regulatory change, it can be something else, but what is actually important for us is to get the signal and then look what are the basic reasons behind that. What is driving the behavior to the, well, direction that we're seeing.
Paul?
It's a very interesting talk, a very interesting approach. The question I have is, how does this differ from what you would normally do within industry under statistical process control, where you're actually trying to do time series measurements on a process and seeing how it diverges, because the whole idea of SPC is to identify very early changes in the process. It'd be interesting to see what just running a standard Q-sum approach on your data would give, which is different to what you've got.
Yep. Well, I don't know about the SFI, but what have been going on. But when I compare these two, it seems that in the finance industry, we are still lacking something, and I think that this dynamic change is actually something that we should look at. So if we're thinking about the AR process, is just one. But if we would compare, for example, the volatility changes and stuff like that, and put all the signals together, we would probably be able to tell a lot more about the structural changes also in the financial areas.
Other questions? Tim?
So a very non-technical question. Is the Bank of Finland doing anything based on these signals, or is your work too early, or what's the practical application?
Actually, we're using these because when we're talking about these macroprudential tools, we have a whole lot of or big set of different kind of indicators which are picked up from different methodologies and from different sectors, different markets, and we're trying to combine all the information and look at it, what it actually tells about the potential fragilities. And this is actually one indicator that we are using, but it's only one.
You rightly emphasized concern about false positives, and I tried to basically keep a running count in my mind as you went through about the relative number of true positives and false positives. Do you have a tabulation of false positives and false negatives, true positives and true negatives that you could show us?
Well, actually, they are in the background material, which was posted in a link. And there we actually have these Monte Carlo simulations, but what we're doing now is just to try to figure out also the false positives in the real market data. But in the simulations, we actually did get just surprisingly few false positives.
And you mentioned you were less concerned about a high false positive rate given a relatively correct true positive rate, and that's presumably because of the regulatory consequences of true and false positives.
Yeah. Of course, our policy function is strange in a way that we like these, not like, but false positives, because it just, these signals are used for that they give us an information or a signal that you should look at these things a little bit more closely. And then do the evaluation. And of course, we are using much more indicators than just these ones. And all the information from different indicators is actually brought into one big picture. And according to that big picture, you are doing the policy reactions.
Great, thank you. Other questions? We still have plenty of time. Roger.
What's the position with respect to being transparent about these sorts of measures? That's one part of the question. The other is sort of related to, is there an attempt by different central banks to put their heads together and get some sort of common element to it? And I suppose those two questions have a bit of a relationship insofar as signaling to the market something about the bank's views about conditions in markets is obviously going to have some conditioning on the market.
Well, concerning the transparency, yes, we are going to be transparent. And the research is going on. Of course, like in academia, we don't have anything ready at the moment because the macroprudential stuff that we are focusing on, and there comes also the early warning indicator job, it's still very much ongoing. But when we are starting, for example, in our bank, when we're starting to do the decisions maybe in January 2015, we are going to publish all the information. So we are trying to be transparent about how we evaluate things and what actually are the methods that we are going to use. The second question?
It was more about whether or not central banks kind of reach consensus about some of these things, if that's possible.
Yeah, actually, we do work together. So, for example, in the ECB, we have different groups that are doing research on certain fields, and we are trying to figure out which are the best ways to look at these things, and indicator job is just one of these.
There was kind of a third part, which is really that as you publish with full transparency, you change the state of the market, you change optimism, which is obviously intended, but there's an insider aspect about that as well.
Yeah. We know it, yeah. But I think it's more like it's fair that everybody knows where the decisions are based on.
Analytics as policy. Any other questions for Katja? Okay, please try and make